those prices high, the margins are very, very high in those, and that's another reason why they're doing so much better. Technology, by the way, was another thing. Historically, technology has, as we know, much higher margins than the traditional other sectors, and technology is a growing part of our economy. So there's a lot of reasons why we can still do well with earnings, even though our GDP is lagging.
So in terms of profits, because it's from overseas, big chunk, technology's doing well, energy's doing well, other sectors are doing well. So GDP can still lag and stocks can still go up?
That's right. I mean, that's one of the reasons why it's been really most remarkable. Earnings projections for 2011, and now it would take a disaster for it to break what I'm going to say. I have surpassed the all-time high, which was reached in the 12 months ending in June of 2007 at the peak of the market and the peak of the economy. So, I mean, even though we know unemployment, employment, a lot of other factors are lagging, we are going to have record profits this year. And, you know, the bottom line is there's two major factors that figure into stock prices. It is earnings and it is interest rates. And both of those are very favorable for stocks at the present time.
Talking about technology, do you think we're developing another bubble with these valuations?
Well, it's sort of, I've been talking to some of the people in the area, and the Twitters and the Facebooks, they do seem pretty rich. But interesting what people tell me, and when I look at the data, I also say, that's not true of the more traditional tech. In fact, by some criteria, Google, Microsoft, Cisco, Intel, I mean, you could go on, are much cheaper than they normally are. So in contrast to 2000, where we had a crazy internet bubble, and the regular tech firms were so high. I mean, the average PE ratio of tech firms, I think, was about 80 in 2000. I mean, the average PE of the tech firms are in their low 20s, which is very reasonable for faster growing firms, and on a basis of cash flows, actually lower. So, you know, yeah, there's always going to be some little area that catches the fancy of investors. It might be nanotechnology, it could be social networks, etc. But I don't think that that's endemic of the technology sector, and certainly it's not endemic of the market.
Now, with your focus on what you might call more traditional companies, does that mean investors would miss out on younger companies, smaller companies, or do you feel that if you want to do fine, you don't have to go in that area?
Well, my last book, which I wrote 2005, Future for Investors, I say
why tried and true triumph over the bold and the new.
Why the tried and true? Historically, people have overpaid for
the new.
I mean, Twitter, you could say Twitter and Facebook are the new. And historically, the technologies over 20, 30 years have not been great investments. Technology sector, even though it's the fastest growing because people put too high a valuation on. Now, as I mentioned to you right now, outside of the social networking, I think the valuations are getting much more reasonable there, so I'm not going to make a blanket statement. But over time, they get infatuated with the new. I think we all do. They tend to overpay. You know, you ask an average investor, tell me the fastest growing company, I want to buy it. Hey, I can tell you those things. Are you going to look at the price? I mean, that's the key variable. I mean, I can give you fast-growing companies, but they're way too expensive to buy. So you have to look at both those parameters when you're making investments.
And talking about PE being at 13, you say you could make a case it should be 18, 19?
It would not be surprising on the basis of historical data, yes.
So that would mean another 400 or 500 points on the S&P?
Yes, it would. It would. And I'm not saying it's going to come today or tomorrow. I'm just saying that if it gets up there...
The clouds are parting in the sky.
The clouds are parting in the sky. If it actually gets up there, it would be nothing unusual in terms of historical valuation. Steve, one of the things that I find said so much about the market is the market is way ahead of itself. People are saying that, why? Because it doubled over a 2-year period. But earnings have gone up 5 times. And really, when I look at price relative earnings, the market is not ahead of itself. In fact, there's still a lot of risk. There's a tremendous amount of risk aversion. People ask me, well, Jeremy, why are stocks so cheap given all these low interest rate factors? And well, it's the memory of the, I mean, the 57% decline in the S&P was the worst since the 1930s. And, those memories don't disappear overnight.
Stocks versus bonds.
Yeah.
Bonds have done very well in recent years.
Yes, they have.
Is that an anomaly, or?
Well, again, when you started out with 10-year treasuries at 16.5%, and you got inflation under control, thank goodness, to a few key people, that Volcker and a few others that kept it low, you're going to get great returns. But I believe forward-looking returns the bond market's very dangerous right now.